They're dumping billions, and as you're about to see, a global liquidity crisis is about to explode. Plus, tonight's show is brought to you by Orchestra Biomed. You can find them on the NASDAQ and the symbol OBIO. And they're an exciting biomedical innovator poised to revolutionize heart health. If you're seeking a high potential opportunity in the cutting edge healthcare space, this one's for you. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's turn to Bloomberg because one major economy is on the cusp of an all-out liquidity crisis. I want you to see how it's affecting their economy and how fast this crisis could spread all through the global banking system. As Evergrande liquidators hire UBS to sell 1.1 billion unit, and now what we're facing is that the fire sales are about to begin. And for the banks and investors who are holding this debt, well, they're about to see the value of it written down. Now, I want you to understand how this can trigger not just a banking crisis in China, but a liquidity crisis all through the global banking system. Because if you think back what happened here a few years ago, we saw the small and mid-sized regional banks take a hit because their underlying assets fell in value as the Fed hiked rates, and that meant there was a dash for cash. The problem is it's going to happen in China. But if you think the U.S. is immune, well, hang tight. We've got risks of our own, and this is going to cause outright panic all over the world. The firm reported net income of 1 billion yuan in 2024, but here's the real issue. It had 3,000 projects under operation, and these are going to sell for far less than face value. Now, we know if they could sell for face value, Evergrande wouldn't be in this situation. They wouldn't have defaulted on their debt, and they would be continuing right along. But one of the underlying issues here is the value of this company has plunged. Now, that's a problem, but it doesn't mean these are going to sell for pennies on the dollar, but they're going to sell for a lot less. And when that happens, well, that's where the liquidity crisis starts, because it means banks all over China are going to be forced to write down the value of their assets. And that means, based on regulations, they're going to raise a lot of cash. The problem is they don't have it. And that means Beijing's going to have to step in to bail them out, but it won't be enough to stop what's coming. Still, any sale faces no shortage of hurdles. Shares in the unit have plunged about 96% from a peak in 2021 and have traded as a penny stock for several years. But that doesn't mean they're going to sell for pennies on the dollar. There is value in this. But again, you think back to what happened here in the U.S. Remember a few years ago, we had a little banking crisis with the small and mid-sized regional banks. And what happened? Bank after bank started to fail until the Fed stepped in. But later the Fed admitted they don't know what they did. They don't know what caused the problem. But again, the issue had everything to do with the fact that the banks were sitting on assets that had lost value because the Fed raised rates. The same thing now is going to happen in China. But again, if you think we're immune here at home, oh no, we're not immune at all, because we have property that we're going to find out that investors are going to panic about when they see what's happening in China. Because China home sales slump deepens as falling prices deter buyers. And can you imagine when this fire sale begins, when the real value of these properties start to hit the market? And what you're going to see from buyers is they're going to dry up in a major way, because why would they buy something at regular value when they can see the liquidators are dumping them for a fraction of the price? This is going to cause major panic in the Chinese property market, one that's going to cause the whole thing to ice up. And remember, the banks are sitting on this debt. They need property developers to build buildings and sell units. The problem is, when consumers find out what they're about to buy is worth a lot less, they're not going to buy at all. And next thing you know, you're going to see the entire Chinese banking system turn into one massive liquidity crisis. The value of new home sales by the 100 largest property companies dropped 24% from a year earlier, and sales plunged 38% in June alone. And what do you think is going to happen in the months to come when the news hits that these unbuilt units are selling for a fraction of their full value? Consumers are not going to pay full price. They're already not paying that, and you can best believe that sales there are going to outright plunge. Now, this is going to spread all across the other property developers. We talked about how yesterday some of them are facing being delisted because they're falling way behind. And that means the weak ones are going to go. And next thing you know, again, it all comes back to the banks. They're holding a massive amount of this debt because, if you recall, Beijing forced them to lend. The problem is, how much is Beijing going to bail them out? The problem is, it's not going to work. It's not going to stop what's coming. And China's residential slump has dragged on for more than 4 years, with prices of new homes sliding to the most in 8 months in June. The worsening decline signals the effects of a stimulus blitz last September that are wearing off. The property sector is in deep trouble, and that is the understatement of the decade, because China's property sector has been struggling for years, and that's one of the reasons they're seeing a lot of economic underperformance. So they're about to hit in both directions. The global economy is slowing, so their export engine is dying off. And then at the same time, their property sector, which employs lots of people and creates lots of wealth, it's going to come crashing down as well. And that means for China's economy, well, where it's headed, the banks don't have enough capital to survive. Now let's take a look at how important the property sector is. Let's look at some U.S. data. We've got new privately owned housing starts in blue against GDP, that's shown in red. And you can see the clear relationship. When housing starts start to tumble, well, what happens is the economy goes right alongside with it. And that's the risk we've been facing here at home over the last couple of years, is housing starts are headed down. Now the risk is they're likely to head lower, but that's not what's going to trigger a massive crisis here in the U.S. But what we are facing is builders are sitting on the largest inventory of brand new unsold homes since the financial crisis. This means housing starts likely to come down. GDP growth here is going to go with it. But again, that's not what's going to trigger an all-out panic. I think it's going to start in China. When people find out the real value of these assets, watch out what happens all around the world. And you can see the spillover effect as China's new loans fell in July for the first time in 2 decades. And this is a major problem for a debt-based economy, because when you are in a debt-based consumption economy, you need to see the constant expansion of debt. That's one very critical point, because when debt starts to contract, well, what it means is money is destroyed in the financial system. And this is dangerous because not only does it lead to disinflation, it leads to deflation and then all-out financial crises as well. Financial institutions recorded a decrease of nearly 50 billion yuan, and this is the first decline since July of 2005. We're talking nearly 20 years. Now everybody, all the experts said, look, there's going to be a massive expansion of debt, but the problem is the banks don't want to lend. And can you blame them? Why would they want to lend into a slowing economy? Remember, Beijing was angry at the banks. They said, look, you need to stop buying government debt. And the banks are saying, look, we want to buy government debt because we know you're going to pay. If we lend, we don't know that they're going to pay. But again, the risk here for China is they go into all-out deflation. That means you not only do you have a liquidity crisis, you threaten to topple the economy and their banking system. But again, I'm going to tell you here in a little bit of what the major risk for the U.S. is, because when people again see the write-down of these assets, well, watch out. U.S. banks are going to be next. Let's take a look at commercial and industrial loans shown in blue against the consumer price index in red. And again, this is U.S. data here so we can get a comparison. And what you find out is that when you see commercial industrial lending move to the downside, even worse, contract. And again, that means money is being destroyed. Any signs of inflation, well, it turns into disinflation and occasionally, like we saw during the financial crisis, outright deflation. Now, right now, we're seeing a small expansion in our commercial industrial lending book, but I'm going to show you here in a little bit, that is going to roll over and head down. We're already seeing the signs of it. So in China's economy, consumers now are backing off and paying off debt, and this is, again, extremely unusual. The rare drop driven by a net repayment from borrowers adds to a slew of signs that households and companies have become even more reluctant to take on debt. Instead, the focus is paying down what they owe as their outlook on future income and growth dims. And again, we've talked about this over and over. When consumer outlook on the economy turns bleak, they start to pay down their debt. They start to increase their savings. And this is exactly what's happening in China, and it happens during every recession. Because again, in a consumption-based economy, you need consumers to borrow money that they don't have and buy things they don't need. And that's what greases the wheel of our economy. So when consumers and businesses back off and start to go in survival mode because they worry about their jobs, what happens is it starts a downward spiral. And what that leads to, in fact, what Chinese consumers are telling us right now is exactly what I've been warning is coming for America. Let's take a look at this next chart of commercial industrial lending against the unemployment rate, and we get a very clear picture of what's going on in China and what's coming here to the U.S. Now, every decline in commercial industrial lending has a matching increase in the unemployment rate. Now, while we've seen the unemployment rate flatten out, all of the high frequency data says that in the months to come, the unemployment rate is likely to move higher. That means here in the U.S., we're going to see commercial industrial loans roll over. Now, what is, again, the problem here in the U.S.? What is the risk that we're facing? It's not in residential real estate. It's in commercial real estate. Keep in mind, those small and mid-sized regional banks, they hold a ton of those assets. And the problem is on those loans, they haven't been written down. But what we see in China, as the value of these assets get written down and they start to experience the liquidity crisis, investors all around the world are going to start to panic. They're going to turn to central bankers. I'll show you a little bit. Well, there's nothing they can do to stop what's coming. The contraction in debt is alarming by itself, and that could be the reason why the government announced the interest rate discount policies earlier this week. And you better believe that's one of the reasons why, because that's how central bankers and governments think. They believe that if you're paying off your debt, that's a bad sign, and they need to get you to go out and borrow. And the reason you're not borrowing money has nothing to do with the real economy. It has to do with the fact that maybe if interest rates were 0.25% less or something to that degree, that you would be excited and go out and spend big. But again, this all comes back to the economy, because what do we see from U.S. consumers? They're worried about their job, and they're worried if they lost their job, they're not going to be able to get another one. And this is exactly what's happening in China. You know, we've talked about youth unemployment there. The government suspended publishing the data because it's so bad. And of course, China, the world's largest exporter, their manufacturing sector very keyed on the global economy. Consumers there know exactly what's happening. They're moving into survival mode, and if central banks cut rates, well, as you're about to see, it won't make a lick of difference. Let's overlay commercial industrial lending with the federal funds rate, and you can see the Fed responds to this here, but it doesn't make any difference. Once you have that downward spiral moving, if the economy is going down with it and the unemployment rate is rising, Fed rate cuts don't work. In fact, they never seem to work. And what is the driving reason for that? Because unemployed people, they can't get a loan. And so if you can't get a loan, that means you can't spend that money into the real economy. And next thing you know, the spiral continues to move to the downside. And you could see the risks here that are happening in Chinese economies. You could see the slowdown happening because people are prioritizing paying off debt and building their savings. Let's take a look at what's happening in their automobile sector. As China car sales slow, as anti-price war drive hurts demand. Now, what did we hear from Beijing recently? That there's a big price war going on in the automobile sector, and that companies need to stop lowering their price because it's bad for business, it's bad for the economy, and what they're doing is creating a massive problem. Well, the real problem for China isn't the fact that there's too much supply. The real issue is there's just not enough demand. And overall retail car sales fell to 1.8 million units in July, now down 12% in June. While sales grew 6.3% year over year, it's slowing from the roughly 15% pace seen each month between March and June. Now keep in mind, if people aren't borrowing, guess what they're not buying? That's right, cars. So you think about the effects of this. The slowdown, it happens just slowly at first, and then it starts to spread. The more people worry about their jobs and the outlook of the economy, the less they spend. At the same time, if you're a manufacturer, you still have to keep the lights on. You still have to keep producing. The problem is you're building cars in this case where there's no buyers. And China's intensified scrutiny of its auto sector on concerns the extended price war that's plagued the industry is unsustainable and risks sending weaker firms into bankruptcy. And this is something that I talked about is going to happen in every major economy, because the risk is when you get a slowdown, there's less demand. And that means businesses start competing for what demand is out there, because they know if they don't, they're going out of business next. And the simple solution is, why are we seeing producer prices rise in China, but output prices at the factory on the decline? It's because they're competing for what business. They're in survival mode. And Beijing's right here. They're going to face the weaker companies. They're going to go out of business. The problem is we're seeing signs of that happen right here at home. But what's the catalyst of all this? Well, you see China's export machine powers ahead, but trade with the U.S. slumped, suggesting that based on what we're seeing in the commercial industrial lending data in China is telling us exactly what's going on in the real economy, and that it's getting worse. And this is something that Chinese consumers are well aware of because they see the slowdown happening in real time. And we expect exports to slow in the second half amid tariffs payback, a front loading, and softer U.S. demand. And again, these are all the things we've warned about. That payback period is coming. In fact, we're seeing early signs it's already happening. And we saw the front running of the tariffs, and we see weaker demand. And this is exactly what Chinese consumers are reacting to. They're seeing in the factory sector that new orders are dropping, backlogs are getting worked through, and there isn't going to be enough work to sustain them. Again, the smart play here is you start paying down debt, you start raising cash, and you stop spending. And again, for a consumption-based economy, what this is foretelling is that China is heading right into recession. And based on what we're seeing with these property developers and this fire sale, you're facing an all-out liquidity crisis that's going to spread all over the world. The extent of the slowdown also hinges on alternative markets like Africa in certain categories, which we already know that China's been dumping things into. That's not going to last much longer because they don't have the latitude. High-frequency data indicates that trade activity is slowing more recently, with Chinese ports processing fewer containers in the 7 days through August 3rd than the previous period, the second straight week of declines. Now remember, we talked about what happened when imports crashed going into the Port of Los Angeles and Port of Long Beach. The demand for labor went right down with it. So what we're seeing here, this decline in lending in China, this contraction, it's a major red flag. It's telling us China's economy is on the verge of heading right into a financial crisis, and the risks of it deflating are huge. And this is all happening despite the fact that Beijing has stimulated over and over again. They've tried lowering their interest rates, and as I've shown you, none of that is going to work. But we can see the effects of what's happening in China, how it's going to spill over to the rest of the world, and it's going to hit the U.S. Because I want you to see that when imports go down, and we already know that imports into the U.S. are dropping, we see that in the data. Let's look at commercial industrial lending, because I want you to see that all throughout the supply chain, that inventory is financed. So when imports go down, as you see in red, what happens to commercial industrial lending? It goes right down with it. And that's what we're facing right now, is that imports are headed down. But what's been driving commercial industrial lending? Well, it's everything to do with front-running the tariffs. And that's the risk we're facing here right at home, because when we start to see these fire sales hit of Chinese properties, they're going to get written down. You're going to see liquidity issues spring up all across the Chinese banking system. You're going to see Chinese consumers back off and not want to spend. They're already in that mode, and it's going to get worse. But when you find out that the banks here in the U.S. are holding large amounts of commercial real estate, investors are going to get nervous as what's happening in China is going to happen here. You're going to see money flood out of that sector, and next thing you know, the liquidity crisis that started in China is going to spread all across the world. But something we're bullish on, well, that's the stock for our sponsor of today's show, Orchestra Biomed. Again, you can find them on the NASDAQ under the symbol OBIO. Everything you need to know in the pinned comment and description below. Let's take a look, because Orchestra Biomed is a biomedical innovator changing lives with their groundbreaking treatments for heart disease and high blood pressure. Heart disease and high blood pressure affect billions, causing millions of deaths every year. Orchestra Biomed is taking on these challenges with two exciting therapies that could transform healthcare for millions of patients worldwide. High blood pressure impacts 1.2 billion people and is a top cause of heart attacks. Orchestra's AVIM therapy uses a pacemaker to lower blood pressure fast and keep it down. Their August 8th press release announced an FDA-approved update to the Backbeat study, expanded to more patients with results expected by mid-2026. And AVIM therapy is a game changer targeting a $17 billion market. A key study showed it significantly cut blood pressure, and the FDA gave it breakthrough device status in April of 2025, as noted in their April 22nd press release. With Medtronic support, this could help millions of patients. And Virtue SAB targets a $4 billion market for heart disease treatments. Partnered with Termu, a global leader, this device could be the go-to option for doctors, offering hope to patients with blocked arteries. Its unique design sets it apart from competitors. And Orchestra Biomed stands out with its cost-cutting partnerships, 4 FDA breakthrough designations, and a team of over 300 years of experience. Their $111 million funding booth, announced on August 12th, positions them to lead in the heart health innovation. And Orchestra Biomed is paving the way for healthier hearts with cutting-edge therapies and strong partnerships. Visit Orchestra Biomed to learn more about their exciting journey and how they're transforming lives worldwide. And you can also find them on the NASDAQ under the symbol OBIO. And as always, any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.